ETF stands for Exchange Traded Fund, and this is a basket of securities that is designed to replicate an underlying index as closely as possible. For example, VOO, the Vanguard S&P 500 ETF, is one of the most popular out there. And this ETF tracks the S&P 500, which is an index of the 500 largest publicly traded US companies. These ETFs trade on the stock exchanges just like individual stocks, and this makes it a lot easier to buy and sell shares of them compared to a traditional index fund or mutual fund. ETFs are used as a means of gaining exposure to a particular industry with ease, or in some cases they're also used as a method of having a diversified investment within one particular asset that you own. However, Bitcoin ETFs are a little bit different than your run-of-the-mill ETFs because instead of owning a portfolio of different securities, you own just one asset, and that is Bitcoin. Bitcoin ETFs are not providing you with diversification because the only asset owned is Bitcoin. Instead, what they're providing you with is ease of exposure to Bitcoin through the traditional financial system. Before these Bitcoin ETFs came out, if you wanted exposure to Bitcoin, you would have to buy it through an exchange and then store it on a wallet if you wanted to have custody of it, and all of these have their own risk factors. Self-custody of cryptocurrency through your own wallet comes with the risks of theft, loss of access, and more, making this a less than perfect option for many. In addition, crypto exchanges do not have SIPC insurance like a traditional brokerage account does. Some exchanges out there like Coinbase have their own crime insurance policy that covers a portion of the crypto held in their storage systems. However, this is not the same as SIPC protection. Through these Bitcoin ETFs, by investing in them through a brokerage firm, investors have SIPC protection, which covers investors against the loss of securities, including ETFs, in the event that their brokerage firm fails. SIPC protects the securities and cash held within your brokerage account up to $500,000, and up to $250,000 of that limit can be used to cover cash in your brokerage account. You can check the list of SIPC members yourself on their website, but for the most part, all reputable brokerage firms in the United States are members. Now, it's important to understand that SIPC protection does not cover you against investment losses that may be experienced when you purchase an asset and the value of that asset declines. But nonetheless, this is a big reason why the Bitcoin ETFs are so popular. You can invest through your traditional brokerage platform and have the peace of mind of SIPC protection. Now, within the realm of Bitcoin ETFs, there are a few different types, and it's important to understand the differences between them. Bitcoin spot ETFs aim to provide investors with exposure to the current market price of Bitcoin. They own actual Bitcoin, and the primary goal of these funds is to track and replicate the price of Bitcoin over time. Bitcoin futures ETFs do not own actual Bitcoin. Instead, they own Bitcoin futures contracts, and these are used as a means of speculating on the future price of Bitcoin. Some of these Bitcoin futures ETFs are designed to give you leveraged exposure, which means the gains and losses would be magnified, or you will also find inverse ETFs that are going to be designed to do the opposite of whatever the price of Bitcoin is doing currently. Not only are these a derivative product that doesn't own actual Bitcoin, they also have costs associated with the Bitcoin futures contracts that are held, and these get rolled over on a day-to-day basis. And this can cause the value of the fund to decay over time. For the most part, investors looking to own shares of a Bitcoin ETF as a long-term investment would want to be looking into these Bitcoin spot ETFs. But it's important to be familiar with both, as both types have now been fully approved by the SEC since January of 2024.